Good evening, everyone. Thank you for joining us today. We'll just give it a couple of more minutes for other people to join in, and then we'll begin. All right, so let's go ahead and begin our session. Thank you for joining us this weekend. And today, what we're going to talk about is the NRI investment opportunity. So, generally, what we've noticed is when there's communication with NRI investors on what they can do with their savings in India or if they want to invest in India, it's a very generic conversation about what NRIs should be doing, right? But there are many geographic considerations that get lost in this dialogue. And that's why we've been dividing our NEO presentations and engagements with investors into specific geographic discussions. So today we're going to look at the US and Canada chapter. And primarily, the reason we do this split is because the investment options that are available to you vary depending on which location of the world you are in. There is a different relationship between currencies, and possibly even from a tax perspective, there are other considerations that need to happen. So when it comes to investing, I think this year we truly believe that is a year that belongs to savers. We know that markets are going to be volatile, and we don't necessarily see that as a negative situation to be in, because this volatility could actually throw up a lot of opportunities on how you plan your investments and uh, finding the best of companies at better valuations. So our approach is actually going to be more staggered, and we want to follow a more wait and watch approach to investing because we know that not all the bad news is factored in. At the same time, um, there is a need to be continuously participating in these markets. So we will arrive at an understanding of how we approach this year, right? So there are going to be years in your investment journey where it's a season to sow, which means what you do matters more than what you're getting back in return. So measuring returns, 2023 is not really going to be a year where measuring returns and making decisions based on returns is going to really work for a investor. So differentiating between the seasons to sow and the seasons to reap is key. And clearly in our heads, the way we are visualizing 2023 and the kind of signals that we're getting from the market would indicate that we are in a season to sow. The next thing that savers and investors need to understand is that valuations and risk move in the same direction. So when you have better valuations, you have better performance, and the risk in making investments at that point is actually much higher. When you have lower valuations, the risk of making an investment decision is lower, and your returns are also low. So we need to move in the opposite direction to actually create wealth. And coming to outperformance, if you want to achieve this, and 2023 is actually going to give us a lot of opportunities to do this, we really need to be scaling up when the chips are down. So combining this approach of scaling up along with a more gradual wait and watch approach is going to work really well for all investors. And the good news in all of this is that you're going to be spoiled for choice in 2023 across asset classes. I think you will find investment opportunities in fixed income as well as equities. So now we look at some of the popular choices that US and Canada based NRIs have. So you have your FCNR deposits, you have real estate. And in the last few years, ever since the pandemic hit, there's been a spike in the kind of speculative investments that investors have looked at, right? Whether it's SPACs, whether it's cryptocurrencies or NFTs, you've seen a lot of this come in. You have ETFs as well as passive investments that have been a popular choice for a very long time, primarily because they're low cost and easy to access. And of course, there are your retirement savings products. So I think in the US, you have the 401k and the ROTH IRA. You also have Canadian investment plans for retirement. So you have registered retirement savings plans. And all of these are asset allocation. So we look at each of these investment options in more detail. So I think with your FCNR deposits, they are issued by an Indian bank. So you're allowed to deposit dollars and earn interest on dollars. And the current rate is close to 4.1%. And the advantage of having an FCNR deposit is that it's only taxed in the US. So on India, you don't have to pay any tax on the interest that you earn. So this is a fairly good return. If you compare uh, the savings account that you have in the US, this is definitely top at, and it's slightly higher than the current money market rates also available. So moving on to real estate, which has been a big sort of investment opportunity for a lot of US and Canada based NRIs. So one, you've had decades of low interest rates. So from the global financial crisis right up until last year, you had close to zero interest rates. So your home loan rates were actually pretty cheap. And now you're seeing that really pick up, and floating rate loans are going close to 7% or higher. Um, y- and now your debt burden, right? What you borrowed to keep your EMI at the same level, you're going to have to extend your loan much longer. Alternatively, you're going to have to spend a lot more on your home loan than what you were doing previously. So um, it's actually become more expensive to invest in real estate. And at the same time, you're seeing something happen in the market. You don't really know where what is going, and you're seeing rental yields also cool down. Um, so your physical upkeep and maintenance is a key component of how um, your real estate works as an investment, because primarily what you spend on the property also eats into your overall return from the investment. And of course, if you're looking at an investment property, it's probably not something that's self-occupied, and that would come with the associated responsibility of finding as well as managing tenants in this situation. And when it comes to real estate, entry and exit actually take longer than we expect. Uh, Primarily because you need to find, let's say you're looking at an exit, you need to find a matching buyer. They need to be coming within your price range of what you want to sell. These things take time. And all of this is applicable even if you're an NRI who's bought property in India. In fact, I think the elements of managing tenants as well as exit could take even longer here than it does in the US market. So now coming back to your banking products, right? So this has become a big, this has become a big area of concern in the US, primarily because you're hearing a lot of news about banks failing. So you've had SVB, you've had Signature Bank, you've had the issue with Credit Suisse, and now I think you have um, another bank that's come into the news. And so, what is actually happening is that, unlike the Indian banking system, I think in the US, you have different levels of regulation. You have deposits which are insured, and you have deposits which are not insured. And whenever you're looking at banking products to create wealth, you need to remember that the banks are the ones who are deciding your investment horizon, right? It's not aligned with what your goals or your wealth creation targets are. So somewhere you are making this compromise so that you can fit the product into your investment universe instead of doing it the other way around. And there are always like fees and incentives involved in banking products, and it's important to understand them, um, to know exactly why you're making certain investment decisions. So if we look at the return perspective also in terms of deposits versus market linked products like say a money market fund, what we've noticed is that the market is responding faster to interest rates than banks, which essentially means that your money market funds in the US are giving you a higher return than your savings bank. And where you're getting a higher return on uh, your bank deposits, you really need to be looking at what is the level of regulation, what is the level of safety that is available in these deposits. And of course, banks predominantly orient themselves towards one asset class, which tends to be fixed income. So this could result in long-term asset allocation imbalances if you focus only on one source of making investment decisions. Then we're moving on to passive investing, right? So I think the intent and spirit behind passive investments or ETFs is actually really great because it makes an investor cost conscious. And that is really key to wealth creation, primarily because if you cut down on costs in the long run, that compounds and that could give you a much higher return. But what gets lost in passive investing is there's this mentality of that it's going to be a do nothing sort of investment where you buy once or you buy continuously and nothing else matters, and over a period of 20 or 30 years you're going to make a decent return. But the thing is that valuations do matter, right? um, the time at which you buy, the time at which you make investment decisions, if you're buying an overvalued theme, then the potential future return that you can make on that is going to be lower than if you buy an undervalued theme. So this is somewhere, this is something that investors really need to do. You can have a passive product, but you need to be a little bit more active about managing it, right? The market is also dynamic, and this is going to be more true in the coming year. And you're still not at real positive rates. You have higher inflation, which could take some more time to cool down. You're seeing some sort of isolated events in the banking system. Are these interrelated? Could it spiral into something bigger? There's a lot of room for change in the market. There's a lot of room for change in sentiment. There's a lot of room for shifts in monetary policy. All of these things could change quite quickly. And as an investor, you need to respond to those cues that the market is giving you. It's not going to work if we're just going to sit on the same old products, do the same kind of things, because we might miss the bus somewhere else. And that's something that we would really want to avoid as much as possible. And the next important thing is people always look at equities as well as your more speculative investments as the one that generate the maximum returns. And there needs to be some kind of mental shift in understanding that wealth can be created across different asset classes, even from the safest ones. So we need to be more active in our approach of choosing our asset allocation and constructing the asset mosaic. So when it comes to US-based investments, there's a weak economic outlook. I think if we look at the Fed's dialogue, they've been quite, um, everybody's been talking about a recession that's going to happen in the second half of the year. You're also seeing your banking crisis slowly unravel. You're seeing this as isolated events today, but we don't know how it's going to evolve over a period of time. Um, you're also seeing a reversal of QE, right? So you've had excess QE over every crisis that has happened in the last 2 decades. And now you're coming to a point where you need to reverse this completely. So for a lot of us, we've never actually been in a situation where we've had high interest rates or high inflation, right? When you're in a situation of high inflation, there's going to be some pressure on profitability because your input costs rise, both on the labor side as well as on your raw material side. the commodity side, what we've seen is that there's been some easing that has happened since last year. But on the labor side, you're still seeing a very tight labor market from the Fed's presentations and talks. That's something that we've gathered. And 2022 was a really strong year for the dollar. Pretty much every single currency depreciated against the dollar. So the dollar started 2023 off on a very high note. And there has to be mean reversion, right? Now, how this mean reversion happens could be in two ways. One is that the dollar could weaken. The other is that other currencies strengthen relative to the dollar, right? So whether this mean reversion happens only in 2023 or over a period of time, or if there's a time correction in terms of the dollar value, all of this is a little difficult to predict the way in which it's going to happen. But what we do know is that from a trend perspective, we have to come back to a more reasonable level. Um, when we look at your funds, right, there's a huge difference between, say, your passive funds and your active funds in terms of expense. So unless there is that much activity and that much performance that comes out, you need to be very selective kind of products that you choose for your US based investments. And we feel that 2023 is going to be a year where there'll be too much volatility for you to really go through with this with a very passive management mindset, right? Where doing nothing, it may not actually work in terms of wealth creation. So moving on to speculative investments. Now, I think what we can do is have a framework and say this is a bad investment when we're in that position of having this opportunity, when we're flooded with information about how people are making a lot of money and you're able to create wealth through these kind of investments. And it always looks speculative only in retrospect. At that point, it seems like a great decision, right? So what we can do is to have some sort of framework that allows us to make this decision, or that makes us question the kind of products that we're engaging with. So the first thing that we need to ask is, how am I actually making money off this product? Like, where are my returns coming from? How is wealth being created and transferred from the product to the investor? So when we ask this question, we're actually looking at the mechanics of wealth creation, and that will help us determine whether this is going to be sustainable or not sustainable. I think the next question we want to address is, what is the general mood of the market, right? Are people willing to take on unreasonable amounts of risk? Are people very confident of how things are going to go? Are people being too cautious, right? What is the mood of the market? Who is getting involved? Who are the investors in these products, right? So when we ask these questions, we try to get into what the psychological motivations behind certain investment decisions are, and whether those things are sustainable or not. Then we want to ask how much easy money is actually lying around. Are people flush with liquidity? Do they have excess savings? Is that what is driving this speculative mentality? Or is it that people are making conscious decisions and with hard earned money, which they are worried about losing? Because the way we approach those two sources of money are obviously going to be different, and the level of risk that we're willing to take with each of them is also going to be different. And now you have to think about the worst case. So what is it that you could lose, right? What if your thesis, when you did your first question and you tried to understand the mechanics behind this, what if you were wrong, right? What is the worst case, right? How much do you really lose? And once you answer this question, you also want to know how widely spread investor returns are, which essentially means that uh, is everyone earning more or less a consistent return, or is there a wide difference between what one person can earn and what another person can earn? Because when returns are more widely spread and not uniform, then the probability of you earning the best return, or even like an above average return, is going to be lower, right? So we need to understand this. And lastly, which is the most important thing, is to understand what regulatory safeguards are there in place to protect you. So in case there is something that goes wrong, in case there are issues related to corporate governance, what do you get back in hand? What is it that what are your legal protections? Because more and more in 2023, we are seeing that this has become really important, right? You've seen this happen with FTX, you're seeing this happen in the banking system. And only now people know what the FDIC is, or whether they could lose money on bank deposits. So now moving on to the two key retirement products, which are your 401k and your Roth IRA. So what are the similarities between these two products? This is basically for US-based NRIs. So I think your withdrawal age is set at 59. So once you cross this age, that's when you can make your first tax efficient withdrawal. Most of the funds within your 401k and Roth IRA, like your eligible funds, are target maturity plans, right? So which essentially says that if you're retiring in X years at Y age, these are the kind of funds that are suitable for you, which essentially is a very passive strategy. And in this is a post-tax contribution. Uh, so when you withdraw your 401k, there's going to be no tax on maturity. Whereas on your IRA, these are pre-tax contributions, which essentially means that your money compounds tax-free until maturity. And at maturity, you are taxed on whatever you withdraw. So the 401k is an employer provided plan, which essentially means that both you and your employer will contribute to it. Whereas the IRA is individual driven. So the onus of contributing and monitoring is entirely on you. You have a lot more plan options in the IRA than you do on the 401k. So now just to quickly look at your USD-INR currency trends. So I think your average 7-year currency depreciation has been at 3.1%. But if we look at last year alone, that was above 9.5%. So what we understand from this is like your long-term average can be a particular number, whether it's currency depreciation, equity market returns, whatever it is, right? But you can have these one-off years which are like way off from your average or your long-term trend. And this is why, again, we're reiterating passive strategies need some active management. Because if you're in a one-off kind of year, you need to modify your strategy a little bit to take advantage trend was last year or what it is going to be this year, because these are really difficult things to predict even for a very well-informed sort of investor. Instead, the focus should shift to your currency goal alignment. So if you're a US based investor and you have goals in the US, let's say you're married and you have kids and you want to send them to college in the US, then you need to have some US based investments, right? But if you wanted to send them to college in the UK, then you need to have more of a currency goal alignment, which would mean that somewhere you should have some assets that are that are linked to GBP growth. If you're looking to retire in India or to buy a house in India, or if you have any goals that are linked to India, then you need to have some INR investments as well. So instead of looking at currency depreciation trends, I think the shift in mentality needs to go towards a focus in currency goal alignment. That would basically help you minimize your currency risk over a longer period of time. And now moving on to this question of tax, I think the first thing is that you should check for a double tax avoidance agreement, because these basically ensure that residents only pay one tax rate, either local or Indian, on their Indian investments. So US and India do have a DTA, and what the DTA says is that you must pay tax in the US and claim those credits in India, because in a lot of cases the US tax rates are higher than the Indian tax rates. Now, regardless of whether you have investments in India or not, the best practice is to file your income tax return. You can always file a nil return if you don't have any income or assets here. Okay. So now moving on to the Canadian section of our presentation. So here your withdrawal age is set at 60 to 65. You have your annual contribution towards your retirement, so a registered retirement savings plan. is at 10.5%. So this is both employee and employer based. So each of you would contribute 5.25%. You also have certain benefits for old age security and guaranteed income. Now, this is targeted more at senior citizens who have lower levels of income, and the benefits are also much lower. So I think the old age security is around $700 a month after you retire. And the sort of options that you have for retirement plans are defined contribution pension plans, registered retirement savings plans, as well as a tax free savings account. So, the tax free savings account allows you to basically put in post tax investments and earn tax free returns on these products. But none of these on their own is going to be able to help you construct your entire retirement corpus. So you do need to plan something outside of this for your retirement. And in terms of tax, it's very similar to the US as well. So even under the Canada and India DTAA, you have to pay tax in Canada and claim the credits in India. And the best practice is to file income tax returns, even if you don't have any income in India. So just a quick look at it was at roughly 4.4%. So again, I think 2022 was an outlier in terms of currency depreciation, primarily because there were a lot of different factors coming into the picture. And the same logic applies here as well, right? No matter which part of the world you are in as an NRI, your focus shouldn't really be too much on currency depreciation because that's something that's out of your control. It's not something that is easy to predict. It's not something that people have even been able to predict consistently, right? So the focus needs to shift towards your financial goals and the targets that you want to reach, and try to have a more geographic approach towards your global investment portfolio. And now I'll hand over to my colleague Harshil, who will take you through the global opportunity.
Thanks, Sam. Thank you. So I thought, let's, put some data to good use and have some fun. Take a look at this chart. Uh, let's say you just put, 100 rupees INR in, the three indexes that I've taken, which are accessible to us. So one is just Nifty 50, and the other is the Nasdaq, and the other is the MSCI World Index, where you get access to the largest developed countries in the world and a couple of the developing countries in the world as well, right? So if you notice in the last but in the last 1 year, what has happened is they've come off 35% from their peak. Right. So this is why that India has sort of been able to outperform both these indexes. And if you see MSCI World Index, it has sort of been very lackluster. Right. So in 5 years, in India, you're able to make about 11.5% sort of CAGR, and for the Nasdaq, it's slightly lower. It's at about 9.5. But the MSCI World Index has been very lackluster at about 4.5%. So why is it that India has been stable and has sort of outperformed the world? It's time if we can just move on to the next slide. Now, India is going through the most unprecedented transformation of human history of human history in the free world today. Right. So first time in where in all our 5,000 years of existence, the three pillars of social, economic, and political are going through some sort of rapid transformation at the same point in time. Right. So if you look at India's GDP in terms of if you have to talk about growth, India's GDP is about $3.5 trillion. Right. So the first trillion took 67 years, the second one took 8 years, and the third one just took 5 years. So from 2015 up until now, India has actually moved ahead of Russia, India, Brazil, and France to number 5 in terms of GDP. And we are probably going to knock out Germany also this year to become number 4. Right. So before the pandemic, India was the fastest large growing economy in the world, and India continues to be a large growing economy in the world, right? So this story has actually just begun. So where has the demand come from? Where has this growth come from? Right. So two-thirds of our entire GDP, of entire growth is actually driven by domestic demand. Everything is inside. Right. This is what India's growth story is all about. Is that demand is way ahead of its supply. Right. And for 8 consecutive years, since 2015, we have set up a record for ourselves. We have received the highest ever FDIs of $83 billion in a year, which was during the pandemic in 2020 when everything was shut. There was nothing functioning. We were all sitting on our mobile phones at home. We were during that point in time, we received the highest flows. It did not come into just the big metro cities of the world. It came up into 61 sectors in 31 states and union territories, which means that the new engine of India is bottom up. It's more inclusive. It's not just the big cities. It's actually every little small town in India that's getting this support from foreign investors. Now, India has the largest human resource on the planet. It's about close to 1.4 billion people. And surprisingly, 1 billion of those are under the age of 35, which means that India is the youngest on the planet all the 2070. Right? This was the study that was done by BCG, where every Indian that was born after the year 2000 will probably spend about 240K dollars in their lifetime. So if you multiply that by the number of workforce that's there, that is what India's GDP is going to look like in 2047. Right. So with our strong currency and rates that are stable, India presents itself investment opportunity for investors who are to create wealth sustainably. But is it easy to create that sort of wealth in India? Sam, if you can just move on to the next slide. So the answer clearly, no. It's not easy to create wealth in India. Every cycle is different. Every cycle celebrates a new winner. Every cycle celebrates a new loser. Look at the winners of the past. Right? They have not actually been the winners of the future. Look at small caps in 2017. Small caps in 2017 were the most celebrated uh, theme, the most celebrated area of the market, and everybody wanted to pile in their money into small caps. Now, what happened after 2 years was a deep correction in the small cap space. You see, for 2 years, it's gone down 23.5%, and then from there it has gone on by 9%. Right. Again, if you look at gold, 2013 to 2015, it had been the worst asset class to own ever. And 7 years later, one of the best ones. Right, 7, 8 years later, you see it's one of the best ones to own gold, and it still continues to be the best asset to own. Right. So the learning that just came out of this for us was that to create wealth anywhere in the world, you need to own the right asset class at the right time so that you can be ahead of the curve and make some money. So what do NRIs actually want? Okay, so that's easy. It's to save money in products that can grow your wealth, that can protect your wealth, and that can help you retire to lead a stress-free sort of life. And of course, make sure that you do all of this by minimizing the currency risk of a particular country. Right. So this is where NIO comes in. There are a lot of products that NRIs get to invest in India, but nothing that takes into consideration the needs of a non-resident Indian. Right. So we have curated this product exclusively for non-resident Indians in such a way that will, unlike if you see a ULIP or a bank FD, where you're stuck and you can't really come out until the tenure is done, with also significant growth opportunities so that you can consistently contribute to the winners of the futures and then later probably use that money to fund whatever goal you want. Right? So it's basically a product where you can just keep pumping money like your 401k, but that takes care of opportunities in India and be on the winning side. Right. So Sphere was not actually born in a day. So NIO did not take us a day to build. It took us about 12 years to develop a product that is consistently capable of taking advantage in any given market cycle across various asset classes. It's not just equity, it's across asset classes, it's across equity, debt, gold, in different sectors and in different themes. Now, I'll give you an example of this. the pharma sector was one of the most loved sector in 2020. COVID happened. People thought that pharma companies are going to save us. Whatever they give us, we are going to do. We have to stick only towards pharma companies. So the sector actually outperformed the broader indexes by 45%. But what came before that was a long, long test of patience. It was not so easy. We started, we started buying the sector, somewhere at the end of 2017. And in 2017, if you recall from the chart, people were mad over small caps. They thought that smalls will take over the large, and the smaller companies started trading at a very high premium to their larger peers, which is unsustainable. Right. So notice that the market's risk appetite was increasing dramatically. The economy had also started heating up, both at home and globally. So we felt that it was, a right time to take a more defensive stance. Now, when we looked at the pharma sector, the sector had actually corrected nearly 40% from its previous peak in 2015. Back then, companies were focusing more on exports, and then their focus started changing more on the domestic side. And also they had started investing more on specialty formulation and wanted to get into their own niche, which was good. So their cycles had to play out. So the thing about Indian pharma is that China, with all its capabilities in the world, could. So our country is the leading drug manufacturer in the world. So when we saw that yes, valuations are getting cheaper, we started buying the sector very slowly. So if you notice from the chart also, it took us a long time for us to start buying, and we've been consistently buying. So the approach that we follow is that of staggered entry, and conviction demands responsibility. So with the able to buy into this space for the next 3 years, and we were able to scale up on our conviction where we bought huge quantities of the sector continuously. So we started buying at 5% of the portfolio, 10% of the portfolio, and then eventually we ended up having a 20% sort of position in the sector until January 20, right? So once the sector came to light, we started cutting down on the sector because it's not that if something has just gone exit is what we are looking for, and the result has been very good for us. It has been that the sector has sort of done, has outperformed the broader indices by about 2.5% over a very long period of time. Right. So what can NIO actually do for you? Now, versatility is the word that you should be focusing on. NIO can help you create a versatile portfolio that can weather and protect you from tough market conditions, to create wealth that will in turn help you meet your future goals in life, right? So with our robust process and our product strategy, we can help you build a solid investment portfolio in India. Now, this is something that we believe every investor must do in order to win. And this is something that we also practice as a house in NIO and all, our other products also. Most with themes and engage with opportunity, right? You'll never know what the right asset is at the right time at the right place. You have to be observant. You have to read everything. You have to keep your ears out open. You have to keep your eyes out open, right? And you have to be patient with themes. The most important thing is be patient. And second, engage with opportunities. Right? It's not that you have to, when you start saving money, it's not that you can stop saving money. Right? And you are choosing investment vehicles where they demand a sort of consistent contribution so that you can build off your conviction, and then in turn use that to align your investment to a particular goal or a particular target. Okay. So the most important thing of how an investor can win is to be patient with teams and engage with opportunities so that you can consistently contribute, build a sizable position, and use that to align your investments to a particular goal or a particular target. So position sizing is the most important thing for every investor to win. Now, in terms of our performance, so we have been in inception for the last 7-8 months. And so we've just started. So if you notice, even from our asset allocation perspective, we still have a good amount of cash on our books that we are slowly willing to deploy. If you notice, our equity stock exposure, it's about 42%, and our ETF exposure is about 8%, and debt does happen to be 28% of our portfolio. So we are tactically playing debt as well now. We've just started. Debt is going to be a very big opportunity in India, and we are on that side already. Right. So if you see, we have taken some global exposure also, and we have taken our exposure into metals, and those metals happen to be gold and silver. So we have that option to invest in on NIO. And just in terms of performance, we've been able to do well. We've been able to outperform uh, set benchmarks. But at the same time, we have just started, and we do aim to do very well in an extremely long-term period. So extremely long-term period doesn't happen to be 3 or 5 years for us. When you compound at high rates for 10 to 15 years, the impact is very large than that of 3 to 5 years. So we've just started. This is what our asset allocation looks like, and be rest assured that our aim is do a lot more in terms of performance and give you that experience in India.
We could.
Thanks, and we'll open the floor for questions. Uh, you can type in your questions in the chat box, and we'll look to address each one of them. So the first question that has come up is in the context of de-dollarization, which is being discussed. Can we reasonably predict the trend in US dollar versus INR? Very tough questions, but I will try to address it uh, well. So de-dollarization is not a theme that has come now. It has been there since the global financial crisis. People have wanted to move away from the dollar. There's petro yuan that is coming up. So yes, trade does want to happen in other currencies. There is also BRICS where they want to add more countries to that list. But the risk of sticking on to one currency is very high. We've seen this now from COVID, and countries are realizing that when uh, they their current macroeconomics does get affected because of reliance on one particular currency. So we cannot predict the trend, but overall long term, you have to protect yourself in that event. So in that event, that's why we have been sticking on to the gold side as an inflation to any sort of risk that can come in on the currency side.
Yeah, just adding to what Harshil said, right? In terms of de-dollarization, if you're moving from, say, like your global reserve currency to something else, like what are the alternatives? I don't think there is like a very strong contender for one alternative to the dollar. But what we're seeing is that many bilateral trades are happening. And even if we look at historically how reserve currencies have changed, that process has happened over decades. It's not something that happens overnight. And sometimes the currency that's not even occupying much of global trade turns out to be the next replacement, which is kind of what happened with the dollar itself. Um, and you are seeing central banks themselves are not sure about how to handle the situation. So if you see the trend in sort of gold reserves that have accumulated from say 2019 till today, there's been a massive push from the central bank sides itself to buy gold. So there's no clear path in predicting how this is going to play out. Okay, so the next question is for folks who are currently in the US, if there is a 10 to 15-year plan of settling in India, would you say now is the right time to start investing? If so, would you suggest going via FCNRO, the ones bank offer without conversion, but for a lesser return rate, or normally invest in the market? Both would make sense. Like you can do a certain amount in your FCNR if you're slightly more risk averse, because essentially you're getting a guaranteed 4% return on those deposits. But if you're looking to come back, then your Indian markets are definitely going to grow at a much higher rate in a 10 to 15-year horizon. So for a younger investor, it would make sense to actually allocate into Indian equity markets through whatever routes are possible for them. Okay, what advantage do I have in a PMS scheme over mutual funds for a moderate risk investor with a classic 60-40 equity debt ratio? Harshil, you want to take this or should I?
Yes, sure.
Yeah.
So now if you take NIO and if you take a particular mutual fund, so mutual fund is just a basket of stocks, and you'll get the NAV at the end of the day on whenever day you choose to invest in. So uh, but for a PMS, it's different. Now, NEO is structured in such a way where it takes advantage of every opportunity. By that, I mean, let's say if somebody were to start today, the portfolio of that investor is going to be very different from somebody who wants to invest 6 months down the lane, because 6 months down the lane, there are different opportunities that can come in. Though the structure might look the same, but there are different opportunities and will look different. So somebody coming in 6 7 months will have a different portfolio than somebody who came in 6 7 months before. Now, in terms of 60-40 classic equity debt ratio, if you look at history, these have not done really well, right? So we wanted to take advantage of any given market condition, right? So which means you cannot have 60-40. You need to be having a very flexi mandate where you can go from 0 to 100 in any. So we have a flexi asset class mandate where we can go from 0 to 100 in any given asset class at any given point in time. So this is the advantage that you have over a mutual fund, because a mutual fund you always have to be 60%. You always need to be 40% into debt, and that's not feasible in every market condition. In every market context, it doesn't make sense for you to have or to stick to or cap because it does affect your returns at the end of it.
Yeah. So going on to the next question, the Sphere NIO product being an asset allocation theme is in a nascent stage as of now. Does it make sense to think of shifting from Solitaire? So one thing is, yes, from a product perspective, Sphere NIO is in the nascent stage, meaning we've only been around for a few months. But this is something we've developed over 12 years. So we did have an RA practice following an asset allocation approach towards advising clients on their investments. So it's not a new product in that sense. But to answer the second question, does it make sense to think of shifting from Solitaire? I would not recommend that. Like if you're in one of the other products within the ecosystem, they follow a different strategy and you have invested for a different reason with a particular investment horizon in mind. So it would be advisable to stick to that strategy and allow it to run its course and perform as much as it can. And as you are able to scale up and you're ready to do a second product, you could always consider Sphere NIO at that point. But it wouldn't make sense to move assets within one product to another. Even without the trade currency, Indian economy is bound to bloom. I think Harshil actually walked us through a lot of changing factors, right? So he was talking about how um, flows are different, how I think even recently in the news, the thing has been about how India is going to cross China's population in a couple of months. Um, Plus, we have like the community, there needs to be uh, a stronger trend in that side as well. Harshil, anything you want to add?
In how currencies are going to shape up. There are countries that are going against the dollar, and there are countries that want to shift their entire supply chain and de-risk themselves from China and move to a better location. There's Japan, there's Taiwan. Again, Taiwan is a big risk. So India does seem to be the best opportunities for uh, investors to set up their base in India and companies to set up their base in India. But one thing that you should look for is FPI money is so FDI money is more stickier than FPI money, which means when FDI does come in, when a lot of FDI does come in, it means that foreign investors are showing a lot of trust into the system, and this money is very sticky. It stays for a really long time. So in that way, yes, there is trust that is coming from uh, foreign players and India investing. Yes, passive investing works for a very long time, but you again have the option to play cycles in uh, passive investing, right? So you need to see how your index is constructed. S&P 500 is sort of more tech oriented, and tech is going through a bad phase now because there are news of recession, spending is coming down, interest rates are high. So at any given cycle, when you're sticking to passive investing, do a lot of study in terms of how they're constructed and how they can affect and how they can get affected, and then have a basket of indexes and have a basket in terms of passive investing. Like layer it up over your conviction. If you are convinced that tech is going to do, just stick to a tech index. Don't stick to a broader index. But if you want to stick to a broader index, then add on to your conviction by.
All right. So we're almost at the end of our session. Do we have any more questions? Okay. If we don't have any more questions, we'd like to thank you once again for joining us this weekend. Harshil and I are available. You could always connect with us on LinkedIn or um, talk to us or reach out to us on our Sphere number as well. And we'll be happy to talk to you about our products if and any other questions you may have. Thank you.
Thank you so much for spending time. Have a great weekend ahead. Cheers.